In this video we are going to talk about best REITs for passive income. So before starting, please like this video and subscribe to this channel for our future updates. Real estate investment trusts, REITs, are a wonderful way to generate passive income from investments in real estate. The average REIT currently pays a dividend yield of around 3%, which is more than double the dividend yield offered by the S&P wink with tongue sticking out 500 index. Three REITs stand out as excellent choices for investors looking to start collecting passive income in 2022. WP Carey & Amp Company, WPC, 0.37%, Agree Realty, ADC, 0.37%, and SLGreen, SLG, 1.55%. 0.36% WPC. They all have steady income and high dividend yields that are expected to keep rising through 2022. Number 5. Simon Property Group, SPG. SPG is the world's largest retail REIT, with a portfolio of predominantly Class A shopping malls. Despite the fact that the road has been hard for SPG in recent years because of the rise of e-commerce, high-profile retailer bankruptcies, and COVID-19 lockdowns, the company still has a good deal for investors. Their success stems from their diverse portfolio of well-located properties, their vast network of existing and potential tenants, and their strong financial position. Their balance sheet provides them with a lot of cash and access to low-cost debt, which they can use to renovate their properties and keep them profitable. Many of their retail competitors, on the other hand, have gone out of business or even gone bankrupt because of over-leveraged financial sheets that have been overwhelmed by bankruptcies and redevelopment needs. While SPG was forced to cut its dividend in 2020 due to COVID-19 lockdowns, it recently increased it by 8%, giving investors a 4.3% future yield. The dividend looks very safe and ready to keep growing, with a payout ratio of 57.4% expected in 2021 and strong FFO per share growth momentum into 2022 on the back of the economy's reopening. While the continuous shift toward e-commerce and away from brick-and-mortar retail clouds its future, SPG has the cash, assets, and network to weather the storm and emerge as the premier retail landlord of the 21st century. For years to come, SPG will be able to stay profitable thanks to mixed-use redevelopments, smart asset sales, and more integration between e-commerce and the properties and tenants it owns and manages. Number 4. Medical Properties Trust, MPW. When you combine an appealing yield with strong growth momentum in a defensive sector, you get a stock that provides investors with compelling risk-adjusted income and total return potential. MPW has such potential. In the first quarter of fiscal year 2019, its normalized funds from operations, FFO, per share increased by an incredible 13.5% year-on-year. The company proceeded to raise large amounts of equity capital through at-the-market sales, which it reinvested in acquisitions for hundreds of millions of dollars in the following years. Because of its extensive presence in the United States, Germany, the United Kingdom, Italy, and Australia, MPW has a plethora of opportunities for raising and deploying capital in order to maximize the cost of capital and cap rate spreads for its clients. The company also has a solid track record of growth, having more than doubled its earnings per share over the past decade while still paying out and increasing its rather large dividend. In the face of COVID-19 challenges, the REIT showed its strength by increasing its dividend by about 4% and its earnings per share by 9%. The only pure-play hospital REIT with decades of experience and a large network of relationships, MPW will likely continue to leverage its position as the only deal-generating pure-play hospital REIT to drive transaction flow in the future. As of now, the dividend appears to be quite appealing and safe, with a projected payout ratio of 64% for 2021, and there is plenty of room for growth in the years ahead. Number 3. WP Carey, WPC. In addition to being perhaps the safest high-yield REIT on the market today, WPC has a dividend growth streak of 23 years, which demonstrates the consistency and sturdiness of its business model. WPC also outperformed its peers in terms of cash flow per share during the COVID-19 lockdowns in 2020, capturing an astounding 96% of their rentals in April and May of that year. As a result, the company easily covered its dividend last year, and is expected to maintain a relatively acceptable payout ratio of 85% this year as well. Because 62% of their lease agreements are tied to a consumer price index, CPI, WPC will be able to take advantage of rising prices over the next few years. Because they have a BBB credit rating, a wide range of real estate sectors, and a wide range of investment opportunities across North America and Europe, they have access to money and a wide range of opportunities to get the best cap rate/interest rate spreads. In addition, WP Carey is seeing substantial growth momentum thanks to $900 million in purchases already in 2021, with weighted average lease terms averaging 22 years. Because of this, we anticipate WP Carey will continue increasing its dividend per share for the foreseeable future. However, even with these advantages, WPC still has a yield of 5.4% in an environment where long-term interest rates are almost uniformly below 2%. Number 2. SLGreen, standing tall amid the pandemic. SLGreen is the most significant office landlord in Manhattan. The REIT's main goal is to buy and lease high-quality buildings in desirable places to high-quality tenants. While the pandemic has had a disproportionately negative impact on the office sector, SLGreen has fared admirably in the face of adversity. Despite the fact that working from home has become increasingly popular, there has been a shift toward higher standards in the office sector. Tenants have rented space in buildings that provide the best facilities, air filtration, and location in order to persuade their employees to return to the workplace. SLGreen has reaped the benefits of this with its emphasis on owning top-tier office properties in New York City. Because of this, as well as its robust financial profile, SLGreen has been able to maintain its dividend growth during the epidemic. Earlier this year, it increased its payout by another 2.5%, marking the company's 11th straight year of growth and profitability. As a result, the yield on the office REIT increased to 5.1%. When you combine that with the fact that SLGreen pays a monthly dividend, you have a great investment opportunity for income-seeking individuals. Number 1. Agree Realty, focused on low-risk retail properties. In addition to holding freestanding properties that are triple net leased to top-tier tenants, Agree Realty is a retail real estate investment company REIT. The company's investment strategy prioritizes investment-grade retailers such as supermarkets, home improvement centers, and convenience stores as major objectives. As a result of the company's concentration on triple net leases, renters are required to bear the whole cost of all building maintenance, including real estate taxes and insurance premiums. Because of this, Agree Realty has a steady stream of rental income coming into the company. The decision to place a strong emphasis on long-term endurance has paid off handsomely. Agree Realty has increased its dividend distribution, which currently yields 3.8% at a rate of 5% per year over the last decade, with the most recent increase of 7.7% occurring in the last year. The fortress balance sheet of Agree Realty provides further support for the company's dividend, which is distributed on a monthly basis. According to the analysts, this company has a healthy balance sheet, few debt maturities in the next few years, and a conservative dividend payment ratio that distinguishes it from its competitors. Agree Realty's strong financial profile gives it the ability to expand its portfolio of properties without sacrificing its long-term sustainability. According to the most recent available information, the Real Estate Investment Trust, REIT, was on track to acquire up to $1.4 billion in additional real estate by the year 2021. Through the third quarter, such transactions contributed to a 10% increase in adjusted funds from operations, AFFO, per share when compared to the same period last year. Because it has a significant level of financial flexibility, Agree Realty should be able to continue acquiring cash-flowing real estate in 2022 and beyond. This puts the REIT in a solid position to continue to grow its attractive income stream in the years ahead. What do you think about our video? Please let us know in the comments area below. If you enjoyed this video and would want to hear from me again, please subscribe and turn on the notification before leaving. Thank you for watching us.